Today on Yep, You're Approved, we're going to talk with Ted Lyons on what a portfolio loan is, what types of scenarios call for a portfolio loan, and see what we can do. So Ted, I guess, can you tell me kind of what is a portfolio loan?
What sets portfolio loans apart from almost every other type of mortgage out there is almost every other type of mortgage is written according to someone's guidelines or standards, whether that's Fannie, Mae, Freddie Mac, USDA, Veterans Association, Federal Housing Administration. There's always guidelines that are handed to lenders, and we're told, underwrite this file, and if it fits these guidelines, if it fits in this box, you've got a great loan, you can sell it, you can transfer it, we'll buy it, whatever it takes. A portfolio loan is a loan underwritten completely in-house by ourselves, funded with our own money, with the intention that it's never going to be sold to anyone. So what that does is it frees us up, lets us get outside of that box, and stretch the envelope as far as who we can help.
Gotcha. Okay, great. Basically, in this market, in this mortgage environment, who's really doing portfolio loans?
Practically no one. I've worked for lots of different companies through the years, and this is the first lender I've ever worked at that does portfolio loans. Michigan First Mortgage, division of Michigan First Credit Union, we have our own funds to lend. Almost everyone else is playing within that same box. And so if you go to lender A, lender B, lender C, lender D, they're all still writing from the same playbook. We have the ability to do things differently here.
Excellent, excellent. And who ends up servicing that? Who takes care of it?
It is maintained in-house. We wind up, there's no one to sell it to, so there's never anyone else to send payments to. They go directly to Michigan First.
Awesome. So can you give an idea, maybe a couple scenarios, few situations where a portfolio loan would be, I guess, appropriate for a certain situation?
Sure. I guess it would fall into two categories. One is individuals and the other is types of property. When it comes to individuals, the situation is there are lots of folks who have had bankruptcies or foreclosures or short sales that are too recent. They've taken place not far enough in the past for them to be eligible for those other types of mortgages that we talked about. In general, if you've got a foreclosure in the last 3 years, every lender looking at every program is going to give you the same no because it doesn't fit anyone's parameters. So individuals, one of the folks in our company has a great slogan, bad things happen to good people. That's a situation where someone has a negative financial event too recent in the past to be underwritten by regular guidelines.
But we're able to find an opportunity to say yes and actually get them into a home and not have to rent if they don't want to.
Exactly, and that's because we look at with our own eyes. We're not just plugging someone into parameters as far as underwriting guidelines. We look at the totality of the circumstances, and that gives us the ability to say yes when other people are forced to say no.
So not as much of a black and white check in the box situation, more of a kind of a common sense type of deal.
Absolutely, looking at the entire picture. So
very good.
Individuals with events in the past, that's one type of folks who can benefit from portfolio loans. And the other is types of properties that just don't fit, again, the same box when it comes to typical lending. And the most common example of that are condominium complexes, and we can talk about that in the future.
Excellent. Well, I appreciate it, Ted. Look forward to talking to you again soon, and we'll see you more next time.